Whenever the US dollar gets stronger, it usually spells trouble for assets like Bitcoin. But here's the twist. What if the very things making the dollar so strong, like all this persistent inflation, are also the exact things that make Bitcoin's long-term story even more powerful? All right, let's dive into this fascinating paradox.
So, that's really the big question we're going to tackle in this explainer. Is a strong US dollar Bitcoin's ultimate weakness, its kryptonite? Or could it, weirdly enough, actually be a long-term catalyst? It's a real puzzle, and we're going to piece it together.
And here are the two sides of that coin. In the short term, yeah, a strong dollar makes everyone nervous. Investors hit the brakes, they go risk off, and they sell assets like Bitcoin. But on the other side of that, the very inflation that's causing all this drama, it just makes Bitcoin's core identity as a scarce, hard asset shine even brighter. See? A total double-edged sword.
Okay, so to really get a handle on this, we need to understand the chain reaction that's going on behind the scenes. It's like a series of dominoes falling, one after another, creating this exact environment.
And here is that domino effect in action. It might kick off with something like governments imposing new tariffs. Suddenly, costs for businesses go up. That leads to what we call sticky inflation, the annoying kind that just hangs around. So what happens? Central banks have to keep interest rates higher for longer. That makes the US dollar a really attractive place to park cash, so money flows in and boom, the dollar gets stronger. And the final domino to fall, investors get cautious and start selling off their riskier assets, which puts that direct short-term pressure right on Bitcoin.
So how can you keep tabs on this yourself? Well, there are 4 key signals you'll want to watch. First, the big inflation reports like CPI and PCE. Second, what are US Treasury and real interest rates doing? Third, you've got the US dollar index, or DXY. That's the classic measure of the dollar's strength. And finally, you have to look at the crypto-native data, things like ETF flows and on-chain activity. Together, these are like your dashboard for the market's temperature.
Okay, so we've got a good grasp on the problem now. The real question is, how do we navigate it? Well, instead of just making one single risky prediction, we're going to build something much more useful. A flexible strategy map that prepares us for 3 different scenarios.
Now, a scenario framework isn't a crystal ball, not at all. Think of it more like a playbook. It helps you get ready for a few different potential futures, so no matter which way the market breaks, you're not caught flat-footed. It's all about being prepared, not about being a psychic.
And this right here is the heart of our strategy map. Let's start with the baseline scenario. This is where the dollar is strong but kind of stable and inflation isn't getting worse. Here you play the range, buy the dips, sell the rallies, and probably stick mostly to Bitcoin. Now, what if things get hawkish? Let's say inflation really spikes. This is when you play defense. You pull back on leverage and slowly build your long-term positions using what's called gradient buying, which is just a fancy way of saying you buy a little bit at a time as the price goes down. Then you've got the accommodative scenario. This is when inflation finally cools off and the dollar weakens. That's your green light. It's time to increase your core positions, and once you see real momentum, maybe even add some of those higher risk, higher reward altcoins.
Oh, and a quick but really important note on Ethereum. It tends to be more sensitive to all this interest rate stuff. What that means is its moves get amplified. In that tough, hawkish scenario, ETH might drop even more than Bitcoin. But in that nice, accommodative scenario, it could bounce back with even more force. It's just a higher beta play, plain and simple.
Look, having a great strategy is one thing, but as we all know, execution is everything. So to actually put this plan into motion, you're going to need the right tactical toolkit. A fantastic starting point is this core/satellite portfolio structure. Think of it like this. About 70% of your portfolio is your solid, stable core, mostly Bitcoin, maybe with low leverage. The other 30%, those are your satellite assets. This is where you put your high conviction plays, like ETH or other alts. This setup gives you that solid foundation, but still leaves room for some serious upside potential.
The absolute key to execution is discipline. You have to build a system that overrides your emotions. So instead of going all in at once, you use a phased entry, maybe buying in 2 or 3 chunks at key levels. And you do the exact same thing when you're taking profits. Most important of all, you set a fixed stop loss based on actual data, not just a gut feeling. This is what stops one bad emotional decision from wrecking your entire game plan.
And to actually enforce that discipline, you can use some specific tools. Conditional orders are amazing. They automate your plan, so your buys and sells happen automatically. It's also really smart to deleverage or just reduce your risk before a big news event, like an inflation report. And finally, use volatility metrics like ATR, the average true range, to set your stop losses objectively, based on how much the market is actually moving. This is how you make your system mechanical, robust, and unemotional.
So as we start to bring this all together, it becomes really clear that we're playing two different games at the exact same time. A short-term tactical game and a long-term strategic one.
This means you kind of need two different mindsets. The short-term game is all about reacting to the dollar's moves, to market news, to overall sentiment. But the long-term game, that's about staying laser-focused on the fundamental story of Bitcoin. Its unchangeable supply, its growing demand, and its long road to wider adoption.
And honestly, that is the ultimate takeaway here. The secret isn't trying to perfectly dodge every short-term storm. It's about building a ship that's strong enough, using a disciplined framework to sail right through them, so you're still on course and ready for that long-term destination.
So as you move forward from here, just try to remember this one simple idea. You have to navigate the choppy waves of the dollar and all the daily market noise. But at the same time, you have to keep your anchor dropped firmly in the fundamental scarcity and strength of the asset itself.